This is completely separate than the capital gains tax. It's the elephant in the room. The tiger by the tail is the capital gains tax. You got to get that under control. But the elephant that's just sitting there is this 40% death tax.
You mentioned cost earlier. So how do the two compare on a cost basis? So say it's the same, say an LP had $1 million in a deal. Their position was $1 million and they're trying to decide, should I do one or the other? How would they, if they're looking strictly at cost, I would say, because obviously there's advantages, there's numerous other advantages to doing one versus the other. But if it's strictly on a numbers basis, how would the costs kind of rack up?
Yeah, so let's break that down. So I call this secret number 3 to a deferred sales trust optimal timing wealth plan, which is this: how to make the deferred sales trust an investment rather than an expense. We talked about the first one, right? Which is, we're going to defer the capital gains tax, but a 1031 is going to do the same thing. We're going to defer the capital gains tax, right? The second one is the timing aspect, right? And so perhaps instead of you selling a $14 million asset and buying a $20 million asset, you guys are able to defer the tax and then buy that same $20 million asset for 18 in a year or two when the market shifts, right? So there's that opportunity cost of purchasing at a lower price, or even buying like 3 deals, over the next 18 months or 24 months at $5 million each, right? And so looking at that, you can still buy the assets, just smaller deals. You're not having to put all your eggs in one basket and overpaying potentially, right? So there's that potential of cost. The next cost was what I talked about. If you're an active investor, if you're a GP, you can get that depreciation new schedule. So you want to consider that comparison. The next one, though, it's kind of hidden, and it's interesting. It's the income tax deferral. So I'll give you an example. We had a client, there were 25 million, and they were selling a $5 million multifamily property in Colorado. And so part of what they were deferring is not only the capital gains tax, but they're also very high income earners. They live in California, right? They delayed the income from the trust. So it's kind of like an IRA, kind of like a 401k, and that for the trust, you don't necessarily have to take payments right away, right? And so their income is high, and this asset was paying them. They had no depreciation left, so it was all just taxable. Now they just transferred that $5 million into the trust. Now it's sitting in the trust, kind of like an IRA, and all of the interest that it's earning, typically 8%, okay, net of fees. Not a guarantee, not a promise. We got to go make the money, right, over a 10-year period of time. Is compounding, and it's building up inside of that, just like an IRA or 401k. So what does that do to their income tax? It goes down, okay? So that's the beauty of this. It's income tax deferral, capital gains tax deferral, and then the biggest kept secret on this one, especially for ultra high net worth clients, if they're listening right now, and those who are worth more than 22 million married or 12 million single, it has to do with the estate tax. So anything above those thresholds, Joseph, are subject to 40% tax. Not going to be in the stepped up basis doesn't matter. The 1031 doesn't solve it. Okay, this is completely separate than the capital gains tax. It's the elephant in the room. The tiger by the tail is the capital gains tax. You got to get that under control. But the elephant that's just sitting there is this 40% death tax. So people have done a few things in the past. They've given a lot away to charity, which you certainly can do. You can buy a bunch of life insurance, which a lot of real estate folks, including myself, we don't like. It's expensive and it's not something that we like to really invest in that much.